Hi, I'm Joshua Dudgeon with realestateinvestmentresults.com. Today I want to talk about loan to value ratio and the importance of it when it comes to investment in a real estate project. Loan to value ratio is otherwise known as LTV, and I'm going to refer to it as LTV throughout the video, is the relationship between the finished value of the project and the loan that is placed on the project to do it. The importance of this is it really is the biggest safety measure in any real estate investment. If you notice when you talk to banks about getting even a home mortgage, they actually have different values that they're willing to receive for a loan to value ratio. Our VA loans are basically the only ones that are 0% down anymore, and that is because veterans have served their country, putting their lives on the line, and that also takes a certain amount of character, which is why loan to value matters to banks and should matter to you as an investment. The funny thing is when you're talking to people about, I need to borrow money to buy a house, and I go to the bank and they want me to bring $20,000 in to buy a $100,000 house if it's a 20% loan to value ratio or 20% down payment, which would be an 80% loan to value ratio. And they are like, why would I bring somebody money if my whole need is to borrow money? Well, the reason that down payment matters to banks is because it shows or it creates the opportunity for the bank to not have a borrower walk away from the loan or from the property. Banks are not in the business of owning real estate. They're in the business of providing mortgages. And so any way that they can mitigate taking the house back is what they're going to try to do. So the higher your credit ratio on a single family home for your self purchase, the better deal you're going to get as far as loan to value goes. Most banks will not go above 95%. There are some mortgages out there that do. Occasionally you'll find 100% that's not tied to VA, but as an investment, the lower the loan to value ratio is, the more you're secured. So we do not borrow any more than 75% loan to value because the 25% not only protects you as the investor, but it also is where our profit lies. Our goal is to make 25% above and beyond what we borrow and finish the project at. Many times it's actually more than 25%. So many times our loan to value will be 55 or 60%. In many cases, we also are conservative on the finished value of the property. So if we're looking at something that, let's say, has a $300,000 investment point or a $320,000 investment point, our finished price of the property should be around $620,000. And if that's the case, you're at almost a 55% loan to value ratio. This is crucial because you know that if the market changes, and let's say we can only get $550,000 for that project, you still being in at 320 are protected by the difference between the $550,000 and the $320,000. So this is why I personally believe the most important safety feature on a real estate investment is where your loan to value ratio is on that finished value of the project. I've had many different mentors over the years as far as I've been through a lot of different programs. One of the first ones, if you know, way back in the day was a guy named Carlton Sheets, and he advised actually borrowing way higher than 75% loan to value, which in the case of his system, if the market drops and you're at, let's say, 90% loan to value and the market drops 12%, that project's underwater and it's very difficult to get your money out. Now, in real estate, if you ever have borrowed up to 90% on a loan to value on a project or even in your own home, it really doesn't make a difference if you're going to stay in the property more than 3 to 5 years, because almost every market goes up over a 10-year cycle. There are very few 10-year cycles. I don't even think there are any 10-year cycles in history that the market stayed in a downward trend. So if you own property that's higher than 75% loan to value, it's okay as long as you can cash flow it and hang on to it. And we'll discuss in another video the next other issues as far as cash flow, what that means, and as well as insurance, like title insurance and hazard insurance, and how those affect your investment as well. With this, pay attention to the loan to value on any real estate project. Remember, banks generally don't lend 100% because they want you to be able to have a vested interest in the property, and you should never loan more than 75% of the finished value of the property as well to protect your own investment. With that, I hope you enjoyed this and have a good day.